Adam and I have actually, I think we may have met, in fact, in Fang originally.
Mhm.
And he and I have known each other for a couple of years, but have gotten to, I would say, gotten to know each other a little better here more recently. And Adam had introduced this employee retention tax credit concept several months ago. It intrigued me. It was something that, while I'd heard of it slightly, had not paid a lot of attention to it, and was very intrigued once learning a little more about it, and have since introduced the opportunity to a number of my partners. And we are very much, I guess, supportive of any business that can qualify, looking into that, because I think it's a great opportunity. And Adam has been a wonderful resource. So with that, Adam, I'm going to turn it over to you.
Sounds good. Thank you, Mark, and nice to meet everyone virtually here. Um, I wanted to kind of maybe explain a little bit about my background, and then I can kind of get into the presentation that I have. And I'm happy to answer any and all of these questions. It looks like some folks are having trouble with nonprofit and 7200s and PPP loans interacting with the employee retention credits and looking at other opportunities. So I'm happy to kind of address as we go along here, make this interactive. I'm a CPA, been a CPA for nearly 25 years. Mark and I've been probably a FANG member for about 8, 10 years, but I just haven't participated just because my schedule just always conflicts with these meetings for one reason or another. Mark and I have probably known each other for at least 8 or 10 years off and on. I have a very varied background. I have done public accounting, tax work. I've done public accounting audit. I've been on the CFO side. I was CFO of a publicly traded company called InSuites Hospitality Trust on the New York Stock Exchange. And there, I had the opportunity to really expand InSuites' balance sheet and change everything around. And I actually won in 2017 the Financial Executives International Group's Chief Financial Officer of the Year for the public company portfolio and the market here in Arizona. And subsequently, I ended up becoming president of the Financial Executives International Group, which is a fantastic group that you may want to look at for the CFOs that are in the group. The qualifications for that group are basically managing a portfolio and a company as a CFO of at least $10 million of revenues, et cetera. So it has to be of size. But anyways, the last couple of years, I have been working with clients to help them in a variety of different ways. And one of the ways is looking at these employee retention credits. Mark mentioned a colleague of his. We ended up helping a client, and we're in the process of helping a client. It's a restaurant chain, and they're in the process of getting close to $5 million back for these employee retention credits. I don't think that folks really understand the employee retention credits. And the more and more that I talk to people, the more and more that there's a lot of confusion out there in the marketplace. And I think the confusion in the marketplace about employee retention credits is it actually was a conglomerate of 3 different bills pieced together. B, it's very, very new. And honestly, at the end of the day, most CPAs, because it's extremely complex, have not had the continuing professional education and the specific time to research the employee retention credits. And unfortunately, they're giving bad information out and conflicting information out to actually what it actually is occurring. So what I'm finding in the marketplace is that unless at this time you go to a specialist to really work through all the details of it, either they're not filling out the forms correctly or they're giving bad advice most of the time, in fact, actually saying that companies are not eligible when in fact they are eligible. So just to kind of give you a hindsight, but why don't I go ahead and walk through this presentation for just a few minutes, and I can address questions kind of towards the end. I'm not sure if you're going to be able to see my screen. So let's just triple check here. Can you, Mark, are you able to
Yep.
see my screen?
Let's see.
No?
Now I can.
Yes, now we
You
can.
can. Okay, now if I move it over here, still able to see the screen?
Yes, we've
Yes.
got, we don't have it on a single slide right now. It's
Is that, now it's on a single slide?
not yet. There we go. Now you got it.
Now you can see it, okay?
Yep.
Now you can see it? Okay,
Yep.
great, thank you.
Perfect.
So it's funny, we ended up creating a website on theaccountingdoctor.com to kind of explain what employee retention credits is all about. And we have a little guy that kind of is sitting on there. We have not named him yet, although we've got a lot of people trying to name him. For some reason, all of our clients want to name this guy. For some reason, it's kind of weird, but it's kind of funny at the same time. But anyways, what I wanted to do is kind of briefly go through the history and eligibility and show you kind of some examples of different clients that we've run into that we are currently helping, and also kind of give you a good understanding of exactly what kinds of things are included in employee retention credits and kinds of things that are not included in the employee retention credits. So here's the history. Here's the specific links, actually. It turns out, and if you look at the Con App is 5,000 pages. I think the American Rescue Plan Act is 7,000 pages. I mean, if you look at these links, they are very, very, very long legislations. And they're not at all user-friendly when you're kind of piecing this together, unfortunately. So we've had to do a lot of studying. We've had to look at the IRS website, which unfortunately the IRS website primarily is just focused on FAQs, the answers and questions. And they've said that specifically the FAQs aren't legal advice. This is crazy from an IRS point of view. But we're going to put out this information because this is the information that we have. Like, really, that's how you actually put out your information about new laws? But in fact, that's exactly how it's working for these employee retention credits. The employee retention credits is basically a conglomerate of a couple of different acts. But basically what it is at a very high level is you are allowed to take a PPP loan, draw one and draw two. Actually, all of our clients, every single one of our clients have taken at least one PPP loan, if not done draw one and draw two. The thing is you can't overlap the same identical wages used for the PPP loan as you're using for the employee retention credit on the forgiveness side. So what does that mean? When people draw money out from a PPP loan, let's say it's $500,000 loan, 6 months down the road, they fill out this form. And the form basically says, okay, we're going to request forgiveness for this PPP loan. Well, it turns out that, in fact, there's two ways to describe how to repay that loan. In other words, you can use just wages, or you can use a combination of wages and a bunch of other things. It's called the 60-40 split. The second half is what is ideal from an employee retention credits point of view. And the second half that I just mentioned is what I was kind of explaining, because at the end of the day, you don't want to just identify all the PPP loan forgiveness amounts associated with wages. You want to split it out between wages and other things. And those other things include anything that's running through cost of goods sold, rent, utilities, just about most of anything that's coming through as an income and expense to your business can be used as part of that 40%. Most folks don't understand that, but that is completely allowed as part of the PPP forgiveness. So I know I kind of went off on a tangent, but it's a very, very crystal point that even though you've got your PPP loan, draw one and draw two, you absolutely can take employee retention credits. And then on this last slide, it turns out that employee retention credits are eligible for 2020 and 2021. 2020 actually starts on March 12th, 2020, and moves forward. And then for, as it sits right now, based upon the laws, it's sitting for Q1, Q2, Q3, and Q4 of 2021. So employers, this is a description about employee retention credits and kind of what it makes it up and what it doesn't. This is all about your 941s. Everything that went through the payroll and the IRS form 941s, which is the quarterly returns, is applicable and in scope to this discussion. Anything you paid to 1099 quote unquote employees, completely out of scope, has nothing to do with wages. But wages from an employee retention credit perspective can include gross wages, it can include tips, it can include company paid health insurance, it can include company paid just about any type of insurance provided to the employee. So it does include quite a bit of a number of different things. The ERC, or the employee retention credits, there's actually two ways to qualify. And here are the two ways. You can do it option 1 or option 2. And by the way, you're not sold, you're not required to use option 1 all the way through 2020 and 2021. In other words, you might use option 1, which is the gross income test, during 2020, and then option 2, which is the government shutdown, for actually Q1, Q2 of 2021, and then in Q3, flip back to option 1, which is the gross income. It doesn't matter. How the gross income works for option number 1 is fairly simple. It doesn't matter the type of business you're in or the industry. It's all about the revenues, not net income, but revenues that the business had. So in 2020, they are looking for, in order to qualify, a 50% decrease in revenues from a quarter in 2020 compared to a quarter in 2019. Q1 doesn't work, but Q2 2020 can be compared to Q2 2019. Q3 2020 can be compared to Q3 2019, or Q4 2020 can be compared to Q4 2019. In 2020, for gross income, you have to have that 50%. But in 21, you only need a 20% decrease, and you're allowed to look back at either a quarter that works for 20 or a quarter that works for 19. So I know I just listed Q1 2021 and Q2 2021, but it also works for Q3 2021 and Q4 2021. So if you had some significant decreases in revenues, and you can compare it either to Q1 or of 2020 or Q1 of 19, doesn't matter, you're in for that quarter. What's remarkable also, and this is kind of crazy, on the gross income side, the way it's worded is it's until you do not qualify. In other words, I had a client who qualified for 2020 based upon the income, no problem at all. Then they qualified for Q1 2021. Sounds good. They had a great quarter revenue-wise in Q2 2021. They automatically qualified for Q2. So it's up until you don't qualify. Well, up until you don't qualify is the day of June 30, 2021. So you get the full quarter and as an additional amount. On the other side of the house, remember it's option 1 or option 2. But on the other side of the house, here you could have you can qualify based upon a government shutdown. And a government shutdown is some kind of regulatory requirement. I'm going to go into a lot of examples of what type of regulatory requirements come in. In order for social distancing, in order from a local county office imposing curfew on residents, dine-in restaurants are absolutely perfect because every single dine-in restaurant in the entire country during COVID had restrictions on their dine-in capacity. They had to take out chairs and tables so they could be at least 6 feet apart. They had to only allow 50% of their tables to be used. The other good news about this is, I'm sorry, I'm getting beeped here. Welcome to tax season for tomorrow. But anyways, the other good news is nonprofits work, S corps work, C corps work, partnerships work, sole proprietorships work. Any type of business can qualify for these credits. How much credits do you get? Well, you get a lot. And here's where it goes. So I mentioned just a moment ago a little chart here. The first part is government order or significant revenue decline. Then what we'll do, and what you have to do, is you have to look at your W-2s and your basically all the wages that were paid through the payroll process. And in 2020, if you had less than 100 employees, full-time employees, or in 2021, less than 500 full-time employees, then you qualify. So how do you determine full-time employees? Well, full-time employees are based upon going back and looking at your 2019 month over month over month over month average full-time employee headcount. So what does that mean? Well, full-time employee headcount is not what you think. It's not just 40 hours a week, 160 hours per month. It's tied back to the requirements that we had for Obamacare, which is 32 hours or 31 hours per week, or in other words, 140 hours per month. So all the employees that were more than 140 hours in 2019 would be added up to determine whether you meet this bar of 100 full-time employees or 500 full-time employees. And so here's what you get. In 2020, it doesn't matter if you're part-time or full-time employee. It doesn't matter if you are, if the labor is union-based, doesn't matter. It doesn't even matter if your payroll company, you are part of a payroll company that is a PEO, a personnel employer organization. That doesn't matter. What you get is for 2020, 50% credit of up to $10,000 for each employee starting time period of March 12th, 2020 through December 31st, 2020. And the thing that you have to calculate and walk through is the reduction of any PPP wages that you've identified as part of the forgiveness. In 21, it jumps up quite a bit. It's 70% credit on the first $10,000 for each employee, but it's not for the year, it's for each quarter. So in theory, you could get $5,000 for 2020. You could get $7,000 for Q1. You could get $7,000 for Q2 2021. You could get $7,000 for Q3 and another $33,000 you can get into your bank account as part of this process. The things that you have to take out in your calculations that are ineligible are the PPP payroll expenses that are associated with the Forgiveness app, any WOTC credits, that's the work opportunity credits, and some companies have gone, especially restaurants, have gotten restaurant revitalization grants. You have to take those out. Let me give you some examples of eligible companies that are part of our client base. We have an HVAC company. They were deemed an essential business. They were required by COVID requirements by the governor. You must stay open. You are not allowed to have any restrictions at the state level. You must service all and residential and commercial customers. The county came in and said, well, you have to abide by the state, but you have extra cleaning procedures you have to do. You have to clean inside and outside of the building for each one of your clients. You have to clean the equipment. You have to do a bunch of stuff. Well, when you got down to it, that restricted the amount of daily service calls that a person could do from 4 down to 3. Boom, you now have a restriction. We have a client here in Arizona, and Mark actually, I'm not going to describe who it is, but you know the CFO, and their revenues were down in 2020, but not enough. They were only 35% down. But then if you look at the company and you look at the restrictions, they had to do social distancing. So most it was primarily women as a clientele. Women couldn't congregate and and talk and meet with their friends and kind of create more of a party atmosphere per se. But they also had to do extra cleaning procedures, and as a result, if you look at the capacity, because they usually could get like 10 appointments in every single salon room, now they could only get on average of 8.5. Boom, they had a restriction. So now they qualify for 2020, Q1, and Q2, all the way up until the governor had made a stance. This is in Arizona, I think in March, that said, okay, we are wide open for business. Everybody, all the rules are lifted. Well, if you read the actual government restrictions in Arizona from the governor, it turns out that he waived during that time only 2/3 of the requirements. The other third, every business is still required to do. Now, whether they're advertising it or not, it doesn't matter. It's still a government restriction that is abiding by by all industries within Arizona, and therefore many do qualify. Another example was we have a very, very technical HVAC company. They create compact chillers and pump tank stations and filtration systems. They couldn't get parts. COVID shut them down immediately. Supply chain issues also qualify as a hampering as part of this legislation. A retail tanning salon in the Midwest, the county shut them down for about 4 months. And when they opened them up, they said, okay, you can open up, but instead of only having 40 appointments per day, you can only have 20 appointments per day. Boom, they have another restriction. A construction company, they do concrete demolition services in New York City. Half their work sites were closed because of COVID. They were union-based, but they still qualify. Here's an example, and this is not comprehensive whatsoever, and it's very, very high level. But on the left-hand side, religious organizations and nonprofits, because they can't congregate and have more than 50 to 100 people, they qualify. Hotels, retail, manufacturing, restaurants, elective surgeons, typically all those type of companies qualify. The companies that can't qualify are the bigger ones. Remember, this was intended for small businesses. Small businesses, 100 employees in 2020 and 500 employees in 2021. Hospitals, attorneys, accounting offices, moving companies, construction companies, they typically can't qualify, but it just depends on what actually occurred and the specific scenario. But I kind of wanted to give you an idea and a flavor of the different industries that we're seeing that are easier to qualify, but not every company can qualify. It's not a broad stroke whatsoever. It's situationally based unless their revenues completely dropped, and then it's a no-brainer. Remember, it's revenues dropping or it's government restriction. So here's an example of a burger restaurant in Cannon City, Colorado. They were limited from March 2020 to April 21. Limitations on dine-in capacity. They had $46,000 of wages that were identified on their PPP forgiveness application. They only qualified for draw 1, but they didn't qualify for draw 2, and the owners were not on payroll. So you literally have to do it. You literally have to go employee by employee and figure out what your wages were, what the available wages were, what the eligible wages are after you take out the PPP, and then see if A, you've covered all your PPP wages, and then the remainder would be employee retention credits. They had 9 employees, $97,000 they're getting back. Another client, Party Supply Store, they rent out they rent out tables, they rent out chairs, they rent out large tents. Their operations were in SoCal, Chicago, and Arizona. And in their particular case, their owner base was really 3 separate companies. They shared the same accounting office, they shared the same CEO, but really at the end of the day, they had different board of directors, they had different, really respective separate organizations and companies. And so what ended up happening is that because SoCal had 85 employees, Chicago had 40, and Arizona had 600, 350 were full-time in 2019. They didn't get anything for Arizona, but they were able to get monies for SoCal and Chicago. And then everyone opened up in 21 for first quarter and second quarter, and they're close to 3.4 million. We didn't qualify, they're not qualifying necessarily for 2021 third quarter, because pretty much in each one of their markets, it's business as usual, and they didn't feel comfortable that they really did have any restrictions. And therefore they're moving forward with just the 3 pieces. In this particular case, it was a combination of gross receipts test, and in some markets, they qualified based upon the restrictions, based upon the technical restrictions, the government restrictions. So it's quarter by quarter, you have to evaluate it. In this case, company by company, you had to evaluate and then apply and figure out what would apply and what's applicable. And that's the presentation. I know it's short and sweet, but I'd love to open it to questions. I'm not sure how much time I spent, probably 20 to 25 minutes, but let me open it up to questions.
Question for you, Adam. So this is Helmote from Craftsman Unity over in Anaheim. In the, you mentioned the IRS's FAQs and how they were not perfect. You didn't say that exactly, but they're not perfect. They usually,
I'm being recorded here, so I was trying to be careful in my words.
Okay. Well, I'm just a guy. Okay. Hopefully none of you are IRS.
I don't think anyone's here is IRS, but I will admit, first of all, they literally said, I mean, in it, like, hey, we're putting this out, but guess what? You can't rely on it. We're like, excuse us? Yeah. Excuse us? What else? How else? Are we gonna look for God for answers? Who else are we gonna look to? Who else?
Hey, I don't compare the IRS with God. It's the other direction. I look downward, but that's just me. Hey, Adam, one of the things they put out was this sort of, I don't know if you want to call it a safe harbor test. It was like a 10% test. What do you have to say? This is sort of like not in gross receipts, but if an employee restriction, for example, we have 165 employees.
Okay.
And about 15 of them are salespeople. It's not quite 10%. And they were restricted from making calls on customers. It really impacted us, although we didn't hit the 50%, we didn't hit the gross receipts target.
What kind of
here we
company are you?
We manufacture cutting dies and printing plates for corrugated container manufacturers.
And weren't your manufacturing supplies hindered?
Not really, not much.
You didn't have, because all my manufacturing clients, every single one's like, I couldn't get parts. If I can't get parts, I can't do work. And it was because of COVID and that supply chain.
We've had some, but not not like what you're talking about, Adam. We've had some difficulty getting parts from Europe because of transportation difficulties in the containers and that. But
and was those supplies? I'm sorry, I'm drilling down here. Were those holding up orders and holding up revenues?
I'm gonna say that no, they really didn't, because we did have we were able to substitute. Okay, so we did not hold orders. We substituted other parts or lesser parts. But Adam, here's my question. There's a IRS circular on this 10% impact. And it isn't presented as if it's hard and fast.
It's not at all. It's not hard and fast. Pretty much, if you are under a restriction and they're just trying to say, hey, what they're trying to avoid is a situation where it's an office and everybody had to wear masks. Okay, well, is that really a restriction? Did everyone come in? That's what they're trying to avoid.
So our situation is that our salespeople could not go call on customers. There were travel restrictions. There were, bans on essential, non-essential people coming into.
You guys qualify.
Okay, perfect.
And if you'd like my help, I'm certainly able to help and assist in any possible way. But yes, you guys qualify. Well, what we're doing, just to let you know, on our side is we're not charging any upfront fees whatsoever to our clients. Honestly, at the end of the day, we don't know if these credits are going to come through. So it doesn't make sense to charge the clients 20, 50, even 100 grand. I've seen bills, people explaining that these are fairly large engagements. We're not charging anything. We're just taking a piece on the tail end and calling it a service fee when you either get a credit or you get a refund back from the IRS. So
is that like a percentage of the refund type thing, or
it is a percent. It is a percentage of the refund.
Okay, good. We can talk further offline.
Yep. I can certainly contact you, but that's basically how it's working.
Adam, I guess the way I'm going to word my question is, can you cherry pick wages and expenses? So in other words, I've submitted several PPP applications for clients under 150,000.
Okay.
And they ask wages, rent, etc. So we list it, and it comes up to 200,000, let's say, for argument's sake.
Yep.
Can I, for purposes of the employee retention credit, say that 40% came from, can I use rent first? Then can I use
so Reuven, so you separate it between the 60-40 rule. So you have 60%, which is total wages. And then each person, basically, you can't give them on the PPP side more than $15,500 or something like that. It's like a $16,000 as a maximum amount. And then you basically can cherry pick and do whatever you want.
Okay, so you can do it in whatever order you want, which best benefits you.
Absolutely.
So you don't have to, like, as I said in my first question, allocate pro rata based on the 200. It can be, okay.
No, first you take the 60%, and then out of 60%, okay, who am I going to do for PPP and get rid of those people? But actually what you do is, well, your first step is you say, okay, of all the people who made more in Q1 2021, who made more than 10 grand? Okay, how much more do they make than 10 grand? Okay, John made 18 grand more. Great, move that over to the PPP. Keep the 10 grand. So you take your ERC first, and then you take your PPP and see if you can cover your PPP.
So in other words, for example, I was thinking first take the owners and their relatives who
No.
don't qualify.
No, owners do qualify, relatives do not.
For ERC?
For ERC, and there's some specific rules you have to apply as well for owners, depending upon if they're 50 or more than 100, more than 50%.
So I
So
can take
You
the,
kind of get in a bag example, but basically, yes. You forget about the relatives of the owners because that's not allowed no matter what. But you take your people and you divide and you figure out who made more than the 10 grand, put that into a separate pile and say, okay, first 10 grand I can use for employee retention credits. After that, I can use for PPP. Do I have enough to cover my PPP?
okay, the only question I'm saying there is, you're saying allocate based on the 10,000. Wouldn't you first calculate the wages on the employers, on the owners, who are excluded from ERC? So you get 100% of
you can
the
do that.
owner and then the excess over 10,000.
Yep, you could do that. That's fine. Yep.
Okay.
Just be careful because I think the owners still are maxed out at like 15 and 16 grand or something on the PPP side.
Okay, I think it's 100,000 a year.
100,000
Wasn't
a
it?
year, but then it was depending upon the time frame and how you have to allocate it. You just have to worry about that one.
Got it. Got it.
All right, Paul.
Take that, Adam.
Oh, I'm sorry. Someone else rang in. Paul?
That's okay. That's okay. No, you can go with Paul and then I'll ask. It's fine.
I'll
Okay.
try to be quick.
Yeah, no
So,
problem.
yeah, I can validate that these are real because we've already, like I said, we received them for our entire employee base for 2020, and that's in the bank. And we received those by just simply not taking credits on our payroll tax liability returns. In 2021 Q1, I filed a 7,200, which is an advance payment
Yep.
request, and that was Q1, and I actually got a check right at the end of Q2. And just for everyone else's benefit.
You did the 7,200, not the amended of the returns.
Correct. I did the 7,200
Yep.
for Q1 of 21, and then I filed another 7,200 for Q2 of 21, and you have 1 month after the quarter. So the Q1 I filed sometime in I think I filed it right at the end of March. The Q2 I filed sometime in July. There was one. I failed to populate one box.
Yep.
They rejected
And they're
it.
kicking it back.
They kicked it back with a letter that says you have to file it within 1 month of the end of the quarter. I tried, I sent it back in, and they rejected it again. So my question for you
And
is,
what was the second time they rejected it for?
they gave this the same reason the first time as the first
Okay.
time. Then they said it was submitted after the end of the month following the quarter.
Okay.
So my question is,
So the only choice now is amended return.
so amend the 941?
Yes.
Okay.
And the problem is, for everybody's benefit, the 7,200s, which is the advance payment request, those are getting processed within 5, 6, 7 weeks. And be very careful on how you fill those out because they are getting rejected over and over and over again. But we've been very successful and very lucky on those 7,200 requests. But what I was going to say is that the amended returns are extremely slow. I've got some March, February that I submitted, as an amendment instead of doing the 7,200 because it wasn't out yet, and it's still pending. So when I called the practitioner's hotline, the last person told me, the last agent said, "Well, I hate to admit this, but," I'm like, "Oh no, here it comes. We've got thousands upon thousands upon thousands upon thousands of these requests, and they're in boxes waiting to be processed. Why can't you process them?" "Well, we're trying to revise our computer program so that they can process them." Really? You had all this time and you can't fix your computer program? That's the story. So they're all being held up for IRS to actually process the returns once they fix their computers.
So have you seen any payments on a amended 941?
Not yet. And then
Not
none of my colleagues and friends either.
What's the earliest? Are you talking going back to March of 21? Okay, so I shouldn't hold my
Well,
breath.
we think
to get it
no.
this year.
But I would put, no, I wouldn't hold your breath to get this here. I'm telling every client, do not count on this money until you physically see a check and it's in your bank account. And I repeat to them, do not literally, like, please do not count on this money. I'm not counting on my, fee. I'm not counting on it. If it works, it works. I don't know when they get to the point of their next bill, whether they're going to cross out fourth quarter, which they're starting to talk about. I don't know if they're going to say, okay, as of this date, these are the ones we're going to accept and all the other ones we're going to reject. We just don't know. We just are telling people, get the amendments in as soon as possible so you're lined up in the queue. Whether it works or not, just put it in and then we'll deal.
Okay, and I believe it wasn't an amended 941. I think our payroll provider put in on the actual 941.
Okay.
And
that
so is
should
that
come
going to go
through
faster?
Yeah, that should come through. That should go through a lot quicker.
Okay.
You should be able
Thank
to see
you.
that. You should be able to see that when you call the practitioner's hotline within 5 to 7 weeks.
So are you suggesting that I should call the practitioner's hotline?
Yes.
Okay. Thanks. That's really helpful.
And if
Adam,
you can't
one
get
thing-
through, then let me know and I can help you.
Adam,
you.
one thing I don't think you mentioned is, correct me if I'm wrong, but if you amend the 941s for 2020
Yep.
and you receive the money, you then have to amend your 2020 tax returns and reduce your wages by the amount, even if you're on the cash basis, even if you receive the money in 2022, because that's what is in the law.
Well, I don't believe it's in the law. I believe it's in the quote unquote FAQs guidance. And there is a lot of discussion within the employee retention credit practitioners trying to push back on that because of the inconvenience that that would create. So I have some clients who have asked that same question, and I'm saying, you know what? First step, let's get the money. Second step, we'll figure out at that moment, in fact, do we have to amend or what we have to do? Because things are going to change, and rightfully so, especially on this specific requirement.
Because I did a couple of ERCs and everything I've been told is there's something in the Reform Act that says it.
There might be, and we may have to go amended and then figure out those consequences, which would
Okay.
say at the moment, hey, don't spend the money because you may have to spend some money on taxes because it's not tax free in a sense. It's basically building up your income to that business. But but clients are like, well, then I don't really want to do this. I said, okay, well, so you're saying to me that you'd rather not receive $100 and give back 20, so you get net $80. You just don't want the $80. And then, no, I want the $80. I said, well, then you got to play the game. It's crazy out there.
Wow.
Absolutely.
Vicky, did you have a question?
I did. So like I said, this is all new to me, so I apologize. But
No
I
problem.
just wanted to check because you mentioned like employee count, and that's one thing I wanted to check on because we file a consolidated return,
Yep.
and we have over 500. We probably have over 1,000 employees, but
Yep. How many are full-time in 2019 that
I
are
have-
over 140 hours per employee per month?
To be honest, I have no idea because I'm in the tax department. So.
That's what you'd have to do. That's what you have to do is do that calculation.
Can you say it one more time?
So what you have to do is you have to pull in employee hourly. You have to find out how many employees in 2019 worked more than 140 hours in January, worked more than 140 hours in February, worked more than 140 hours in March, you see where I'm going? And then you take the average of those numbers and see if you are over 500.
Okay.
And if you're over 500, then just move on because employee retention credits won't work for you.
Okay. And can you break it down into like the subsidiaries because we,
Not
or is
because
it
you're
or is it
consolidated returns, so it's
returns?
all
So it's
together.
on the consolidated. Okay. And
It's on a
then
consolidated basis.
okay. All right. I'll check into that. And then I guess on their second point, when they were talking about the amended returns, because I think what we were going to try to do, we're a fiscal year filer and our return is due in December. And so I think they were trying to get this stuff for 21 somehow to go through our 21 tax return so we wouldn't have to amend it. But you're saying we shouldn't.
At this moment, once you get the money, then you figure out what the current
What to
stance
do,
is,
and-
what to
okay.
do. But chances are you're going to be amended.
Okay. All right. Thank you.
Mark, lots of good questions here. Wow,
There sure are.
lots of good questions. Okay, I've sparked some. Liz,
Hi.
Hi,
So
how
I
you
have-
doing
I'm
today?
Good. How are you? I have a few
Good.
questions. Cool. So you were talking about timing of shutdowns, and so for first quarter 2021, and since March of last year and through the first quarter 2021, our business had to be closed.
What state are you in?
California.
Oh, okay. And is this the wellness company or is this the music school?
This is the music school.
I
yeah,
took
so
notes
for
on
the
everybody.
kids-
Sorry.
Yeah, it's the kids' music school. So they had rules based on like numbers of cases and things like that as to when
Okay.
it could be open.
Yep.
So we were able to open up in April, but not the 1st of April. So
It's fine.
so that means,
Did you
So
have
for sec-
employees in the Q1
so
2021?
we had employees the whole time. We switched from in-person lessons to virtual.
Okay.
So we lost business, but we never.
Yep. You're going to
totally
qualify.
shut
You
down.
qualify.
Okay.
You guys qualify.
So
Probably
because
all the
it
way
was,
through.
so for the whole second quarter, we can.
You qualify for Q1. You qualify probably because of revenues. You probably qualify for Q2 and even Q3 and 2020.
Well, 2020, yeah, we definitely,
Yep.
We're
I think you
closed.
qualify for all. How many employees did you have?
we have something like 60 something employees.
Okay. Yeah.
So you're
I'm,
saying partial shutdown in April gives you the whole second quarter.
Well, no, you're going to have qualification based on revenues in 21
Well, okay, so here's the other,
because you only
So-
had in Q1 2020, you probably had a dip of 20% of revenues.
yeah, so there's a couple things here. We have 5 different schools and they're all
Okay.
separate entities, but
Okay.
we run payroll from one
Okay.
entity and allocate that to the other.
And the
things.
ownership of the 5 schools are
50,
common?
50.
Yep.
Same
So it's going
ownership.
to be more at the consolidated level than at the individual, but it sounds like you're less than 100 employees, so it doesn't matter.
Well, okay. But you're saying as far as government shutdown in second quarter, I qualify because I had
No,
a few
I'm
days.
saying you're going to qualify. My gut feeling. Well, we have to engage in a letter. We have to walk through this, but my gut feeling is Q1 you're down 20% in revenues in Q1 2021.
Well, we were
and-
shut down by the government, so I didn't.
Yep. So I'm
but
sure
we
you
were-
were
Yeah,
you were down. So that means you automatically qualify for Q2 21.
but in the second quarter, certain locations were not down by more than 20%.
Didn't
others
matter.
were.
Doesn't matter. Doesn't matter at all. You automatically get if you qualify on the gross receipts test for one quarter, you automatically get the next quarter. It doesn't matter if your revenues are
see.
up. It doesn't matter if you had less employees. It doesn't matter if you had more
Okay.
employees. It doesn't matter if you shut down. It doesn't
Mm.
matter anything.
One in, so if you qualify in any quarter on revenue test,
On the revenue,
automatic-
you get the automatically you get the next month quarter.
automatically get next quarter. But then what? Okay, so then what about quarter? The quarter
So then
afterwards?
Q3, so then we have to look at Q2. And the question is Q2, did you have a 20% dip or not? If you
Okay,
had
so
a
that's the
20%
thing.
dip,
Some of them, some locations did, others did not.
yeah, altogether. Altogether.
Possibly not. I'd have to look again.
Okay, so we'd have to evaluate and
Okay.
look at the whole thing.
So for third quarter, look at second quarter revenue. Okay.
Yep. Well, third
Okay.
quarter, What state are you in?
California.
Yep. I'll bet you anything. You probably have restrictions in second quarter of 21.
For part,
Government restrictions for part.
for part of it.
Yep. What about third quarter?
No, I mean, we were able to be open.
So in order to get third quarter for ERC credits, you'd have to have a dip in revenues in second quarter.
Okay, second quarter. Okay.
I'm happy to talk to you
Yeah.
offline
Okay.
and kind of walk through this.
Thank you.
Sure, not a problem.
Appreciate it.
I'm assuming I'd get some of these email
Yeah.
addresses and contact info, and I can reach out to you, Liz. It's not a problem.
Can I
I
ask one
just
more-
put your email address in the chat box, Adam.
Did you get the right address?
We'll take a look at the
Yep,
chat
A
box.
Remus at the accounting doctor. Yep.
Because I have to close the room in 5 minutes, folks.
Oh,
Yep.
Right.
Hey.
Adam, you are working on, you're working with clients nationwide, correct?
absolutely. And
Okay.
Puerto Rico
In Puerto Rico, okay. Yeah, I'll
and the
get in
Virgin
con-
Islands qualify.
I'll get in contact with you.
So
Hey,
so I know I need to follow up with Woody and Liz. Who else do I need to talk to? David?
Yes, please.
David? Is there anyone else? Then I can just I'm sure I can kind of get information on everyone. Who else I need to follow up on?
Francis, I would love
Francis?
to, yes, I have a question about retroactively applying for 2021, not 2020, because we use most of our revenue for 20 to apply for forgiveness. So I don't think we can do that. Is it possible to do that after we've applied for forgiveness?
I didn't, well, yeah, yes, the answer is yes, absolutely. Some of my
Oh.
clients have applied for the forgiveness and got the forgiveness. Some of them haven't applied. And for those who have not applied for the forgiveness, as part of our service no charge, we just help them with those forms.
Okay.
We're like,
Can I
no,
ask-
no, 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 we want you to fill out this way. So we'll do it. So can we just fill it out, please? Can we just fill it out? And we're like, we'll just give us a couple more pieces of information, and here it is. And then they present it to the banker. Oh, my friend or my CPA filled it out. Is this okay? And it's accepted and just moved on.
Okay.
Can I ask one other quick question?
Yes. Hi, Vicky. How you doing?
Hey, do you have to, I think what they're trying to do is they're trying to look at types of employees, like for instance, our marketing people that wouldn't have been able to conduct their jobs. They have to look at the total number of employees per the organization, not per a specific department, because
Correct. It's a total amount.
total employees. Okay,
Total
great.
number of employees,
Employees. Okay.
100 versus 500.
500. Okay.
Yep. And it doesn't matter. It doesn't matter if you're what's not labor, union or anything.
Yeah. So it doesn't matter that, that this person's job wasn't affected, but this
Nope,
person's job was.
does not
Okay,
matter.
Does not matter.
at
Okay,
all.
great. Thank
Doesn't
you.
matter at all. And Vicky, just to also go down the road, and this might help. This helps Liz, just to give you an example. Let's say Liz's one school was affected, but the other schools weren't. Boom, it's applicable to everybody.
Mm.
You get everybody. You don't have to go school by school by school, or location by location by location. You don't have to worry about, or department by, nope, none of that. So I've
Let
got,
me-
so Woody, Liz, David, Francis, who else?
Paul,
Paul?
it's what you just mentioned. It's a kind of a qualification question, because as my nonprofit has 3 distinct programs, 2 of them would have been impacted, but the
Doesn't
third one
matter.
actually-
All of them apply.
Okay.
Doesn't matter. Church,
Adam,
a church
can I-
applies. Just to let you know, all your churches and for Reuven and I did my synagogue, for example, Reuven, just let you know,
Yep.
they apply because you couldn't congregate more than 50 to 100 people. That and for churches on the church's side, that's how they get their money, through tithing. Well, people couldn't show up to the church, they couldn't give the money, so therefore they had a restriction.
So we're a
So,
homeless, we're a homeless
Adam-
shelter. If I
Adam-
could just wrote one super quick. We're a homeless shelter. Say, for example, a large emergency shelter could hold 50 beds, but because of distancing, now we're down to 30.
And you got paid based on beds, right?
We don't get paid. We just take donations. So it's an operational shutdown.
you probably would be able to be qualified. I'd have to talk to you a little more about that.
Okay,
Adam,
yeah,
I-
I'll
What I
shoot you an
was
email.
gonna suggest is, I have to open up Kansas City, but they're having a general networking meeting. So if you like, I can send everybody on this call the link for Kansas City, and we can all go and meet in their room now, if you'd like.
Well, but I think we're kind of deep into these discussions. Can I just get a listing of who to talk
You
to follow
can
up?
find that out because you're a
Adam-
member. You can look
Adam-
at
Adam-
you can look at the list of everybody who registered.
Yeah,
Adam, I think to make it easier for you, have anyone who wants to contact him, send him an email with your question. So he doesn't have to hunt and peck. And that way he can answer your email. Leave it on you, not him to search, please.
Yeah, I'm happy to follow up with folks. So Woody, Liz, David, Francis, and Paul.
Maybe Vicky, I'll need to talk to.
And
But,
Vicky.
but that list is available to members. When you look at, it's going to be under past meetings now.
Okay.
But if you go to the website, you would be able to
I
find that.
haven't been in my account forever, so maybe Mark might be able to help me here. But
Yeah, I can help.
Mark
you.
can help me.
Yeah.
All right, well, this is a lively conversation. Thank you so much for the participation. Really, really appreciate it. And hopefully this adds some light to this very complicated rule and regulation brought to us by our friends from the Internal Revenue Service.